Welcome to the REI Hacker Podcast, where we unlock the secrets of real estate success. Join us as we dive into the journeys of top investors, mentors, and industry experts. Learn from their experiences and navigate the highs and lows of the investing world. And now, let's hand it off to our host, Benson Juarez.
Welcome, everybody. Thank you so much for being here today on this edition of the REI Hacker Podcast. I'm really excited for my next two guests, something I haven't done before. Typically, we do one-on-ones, but I actually had the personal pleasure of working with these two guys on as a client. They've helped me to do some tax planning and some estate planning in the last few months, and so I really wanted to have them on so they could share their backgrounds and talk to us about what they do and how they help people. So this is Stephen Peterson and Jason Rotman of Elevate Financial Partners. It's a financial, estate, and business planning advisory firm helping high net worth individuals with wealth accumulation, tax strategies, and protection plans. Gentlemen, thank you so much for taking the time and coming here. I know you're really busy hanging out on jets and flying around the world, talking to ultra high net worth individuals, but you're taking some time to hang out with us today. So I appreciate that.
Thank you.
Our pleasure, for sure. Very happy to be here, Benson.
Yeah, super grateful.
Yeah, it's been a fun road. I had, the unique position to be able to work with you guys intimately and go through the whole process of just, Jason, you reaching out to me from a post that you did on TikTok.
That's correct.
And then all of that kind of like, trust building and working through like, okay, is this guy just another charlatan, or are they actually somebody I can trust, my financial future with? And we went through that whole process, and I kind of ran you through the ringer, right? Which people should, right? And then we got to a place where I finally felt comfortable, starting to divulge some financial information and getting into the whole process of, building a plan based off of what I was looking for, and then ultimately setting up a process on the back end, which we recently just finalized. So it's been a really amazing ride, and I appreciate both of you for taking me through that.
Of course, man. You've been nothing but a pleasure, honestly. You've been great. We like working with you.
Yeah, it's been good, and I would assume you work with all different kinds of people, right? So it's in the description that I just get, I said ultra high net worth people, but I'm not ultra high net worth. I want to get there one day. So there's this balance of like finding people who have a lot of money to people who like have some revenue, and they're starting to think about retirement, starting to think about wealth accumulation. They're concerned about taxes. And then maybe they have, family members that they want to make sure are taken care of if something were to happen. So, let's get into all that in a moment. But you guys have some really interesting backgrounds. You've both been in the industry. You've got an accumulated over 30 years of experience in financial planning, which is pretty impressive. Tell me a little bit about, your backgrounds and how you got into what you're doing.
For sure.
Yeah, I'll start. So I started in the financial world in 2002. Out of college, I played football at Princeton, and I met a lot of amazing people there and learned a lot. And one of my friends that was on the football team, actually, that I was close with, I ran into him after we graduated, and he was a day trader for a top futures trading firm in Chicago, which is like one of the futures trading capitals of the world. I mean, Chicago and London, basically. And so he got me an interview, and my first job in finance was a day trader. So I was that kind of classic day trader in front of the screen, making 50 trades a day and, glued to the charts and whatnot. And, it was just such an incredible educational experience from a financial knowledge standpoint in more than one way. I mean, first and foremost, really, I still bring those experiences and that knowledge to what I do today, even though it's very different. But I learned so much about, the global economy. And if this happens here, this should happen here. Interest rates, macroeconomic cycles, jobs reports. What is, if the Fed says this, that's what means for this. Like literally, it just put a whole puzzle in my mind together as to how the world economy works, honestly. And like, some people may not think like, well, what's the connection with that and day trading? Well, it's like you have to, like, the best day traders know the big picture in order to make those micro little small picture movements. Do you know what I mean? And so it was just such an incredible educational experience. And so I was in the futures trading world for a long time. And kind of phase two was I was not a day trader, but I was a money manager. So I was building a book of business of high net worth investors, you know, family offices, etc. So now I moved from the day trading world where it was just me and the computer, literally me and the markets, to reaching out, you know, meeting other investors, talking to very advanced, very astute, savvy investors who that, and even in that experience, I learned a lot from just being on the phone, being in the room with these people that have had a lot of success and just learning foundational principles as to how they operate in their world. You know what I mean? How they think, really. And that was kind of phase two. And now I would just spontaneously just put it into phases. You know, I've been in this phase three for a while, which I absolutely love, of advising high income executives, to your point, not only people that are, you know, whatever, worth 50 million or higher. We have clients like that, but there's certainly, all of our clients are not only like that. And we work with high income executives. We work with startup businesses. We work with extremely wealthy families. But now I just personally feel like I have the privilege and joy, honestly, is what it is, of bringing all of this phase one and phase two knowledge from my former careers within the realm of finance, obviously, to now bringing, you know, bringing all of that knowledge to helping families from kind of like the passion of my heart, which is from a family experience that I had, which I can get into. I can bring that passion into helping families and helping individual investors and humans like you, Benson, do long-term, highly advanced, sophisticated, intelligent financial planning that, even though they're not ultra high net worth today, they're behaving as though they are. They're starting to do the habits of the ultra high net worth, you know, set, that if you start to do those habits, even, it's the same thing. It's just maybe 1 0 less, like, or 2 zeros less, but you're doing the same things as the people that Stephen and I have come across that are worth 50 million or 100 million or more. You're starting to do those things that we're advising you to do, so that as you grow, you have the structures in place to just add 1 or 2 zeros to those very things that you're starting today.
I love it. And Stephen, you're the founder and managing partner of Elevate. How did that all come to be?
Yeah, good question, man. So I started my career at Northwestern Mutual, and you know, I'm super grateful, internally grateful for that experience. I played football in college like Jason. So coming into to this business, I don't have chapter 1, chapter 2, chapter 3. I've been in the same. This is all I've known in my whole career, actually. So I started here, I started at Northwestern when I was 23, and you know, I got into the business because I wanted to help people, and I studied, you know, economics and finance. So I understood that, you know, the blueprint of the industry, but I genuinely believe I'm alive today to impact people and help people, professionally and personally. I think it's my calling. I've had some scares in life, with death that have come pretty close, and I think that the reason God has me alive is to impact people. So I take my career very serious, but how I got into this space is I started as a 23-year-old. Northwestern made me go get 250 to 300 names of people that I could reach out to. They gave me a phone, and what I learned was this is an activity-based business, so it's a numbers game to help people, really. So I actually excelled very well at Northwestern. I was top of the company for U5, so that's under 5 producer. And then after that, in the company, I was still top rated as a producer. And then I was also a director. So I recruited, I developed, I trained, and I learned that I can do this by myself. Northwestern Mutual is great because it gives you the training and it gives you the blueprint of how to do this business, hire your own staff, do everything by yourself, quite frankly. But what I wasn't in alignment with there was I am a fiduciary-based advisor, so I take it very serious to do what's in the best interest of my clients. And Northwestern, we were talking about one company. So the financial service world is vast. It's huge. It's very broad. There's a lot of companies that are really good, by the way, at certain things that aren't as good as other companies. But I wasn't in alignment with talking about one company. So my vision was to ultimately have my own firm that was independent, that we could represent over 100 life insurance carriers, that we could have an independent chassis for investments like we have an RIA, and that had the best partners in their roles. Because I come from a family of attorneys, so the law firm world makes sense to me. And at law firms, you have partners that specialize in different areas. So my vision was to create a financial firm that will ultimately grow into an institution where there's partners that represent certain sectors of the planning space that are better than certain other partners. Because I never wanted to be the jack of all trades advisor. I want to be an expert in business planning, and then I want to bring in an advisor that's an estate planning specialist like Jason, or like my other partner Tony, who's a financial planner, or like Tibbs, who's a cash flow analyst, right? Like we all have our niche at Elevate. So the vision was to create an independent firm that's completely unbiased in recommendations, and that we can genuinely help people elevate from the day that they come here. We want to elevate them to get them better to whatever their goals are. And that was my vision. And honestly, in the 3 years that Elevate's been in existence, we've done phenomenal. We have grown tremendously, and I'm extremely grateful for the team, and also just like our clients. Because Benson, when we left Northwestern, over 87% of clients came with, which is a big deal.
Wow.
Yeah.
That means that you took the time to build that trust with them, and they wanted to work with you. Not
Correct.
It wasn't the company that they were wanting to work with.
Correct.
Exactly.
But they found you that way, right? And so you had the ability to build that foundation. That's what's pretty exciting to be able to do. And so you've been around for 3 years, and you've worked with a whole range of people. And we come from a real estate background, so most of our listeners are real estate investors, aspiring real estate investors. Some people are starting to make some money, and we get the benefit of being in some really cool rooms, right? So when you elevate as an investor, you want to be with people who are making more money than you are.
For sure.
And so you start to learn some strategies. What are people doing? And so maybe you start off in the wholesale world, but then your goal is to be a fix and flipper. And then the fix and flippers are trying to generate cash so they can buy rental properties. And then rental property people are starting to think about, okay, well, I need deductions, right? So where can I find some deductions so I can limit my tax exposure? And one of these vehicles that's come up a lot in the real estate world is what some people call infinite banking. I know that's not the technical term of it, but it's something that I've been hearing about for years in the circles that I've been in. And I always knew that high net worth people were leveraging this vehicle as a way to generate revenue, protect their investment where you don't get the ups and downs of the market, but still earn, interest like it was in a fund, or if it was in, some interest bearing account, but also be able to take that money and invest it tax free. And that's what originally attracted me to you guys. So let's start talking about some of these different vehicles, starting with Whole Life.
Love it.
Yeah, go first.
You want me to go? Okay. So
Yeah, sure.
I to kind of go back to my beginnings in this business, I come from a major mutual land. Northwestern Mutual is one of the biggest. So being in the independent space now, I'm grateful, we represent the largest major mutuals in the marketplace. So
Let's explain what a mutual is to the listeners.
okay,
Yeah.
so there's a mutual company is owned by the policyholders. It's not publicly traded, so you can't go invest in Mass, Guardian, Penn, Emeritus, Northwestern. You can't go buy their investment account on the New York Stock Exchange. The only way to get access to the investment account and the strength of the company is simply by buying a life insurance policy. So they are mutual companies don't send out shareholder reports. They don't have earning reports. They don't have any of that. They are strictly in business to support the policyholders. So it's like a giant co-op. That's the easiest way to explain a mutual carrier. So, or a mutual company, honestly. So, with the banking side, infinite banking, I love whole life. I think it's, you'll hear people talk about universal life, index universal life, variable universal life, or whole life. I personally think from a math perspective, that whole life insurance performs the best in the IBC infinite banking concept space, because the guarantees are going to be higher than any UL chassis. Typically your lend ratios, your lend rates are very favorable. And then if the company is good and they have strong product performance factors, the internal rate of return is oftentimes higher than your borrowing rate. So if you borrow from yourself at, let's call it a 4% interest rate, but let's say Guardian has that S&P 500 rider on there. So if you're getting let's call it 10% interest rate on your whole life insurance policy that has the standard deviation of a treasury bill, so it's very safe. You're borrowing at 4, but you're making 10. That's a 6% spread that you're making on your money. And then you could deploy those dollars into something else that's going to generate a higher rate of return. And you literally just multiplied your principal. And you can't really do that at a normal bank. So clients love infinite banking because you have an arbitrage play associated with it. And then to go even further, you can pledge those monies with banks, and then a bank will give you a line of credit. And so you can now use the bank's money, and you can deduct those interest rates. So once again, it's an arbitrage play, but now you're using OPM, so other people's money. So infinite banking, you guys are in the real estate space. So Benson, we work with a ton of real estate investors, private equity, real estate finance, corporate real estate finance, real estate investors, real estate developers. I would say their favorite tool is cash value life insurance from the lending perspective, infinite banking.
That was one of the things that surprised me the most. And actually, I just learned another factor here, which we didn't get into, but that whole idea of the arbitrage, where you have a policy that's getting, like you said, upward of 10%. And then I can basically borrow money from my policy, take that money out, go and invest it, and earn a new set of returns on that. Maybe I could do private money lending, or I could do a fix and flip, or I can use that money for earnest money deposit on a wholesale deal.
Yeah.
But it's still earning interest, even though the money is elsewhere.
Done. Exactly.
It's like, that to me is just mind blowing that is even legal, but it is.
Yeah.
And this is the kind of thing that the wealthy people have been doing for years, because, it takes money to make money. And it's these high net worth individuals who know about these high end strategies that the average person doesn't know about and can't leverage.
Yeah, I would even say at its most conservative, right? Because it's easy to talk about all the exciting things in a sense, which are true, by the way. But at its most conservative, I just think the reality is, which is easily provable, that dividend paying whole life insurance in particular, again, as Stephen mentioned, there is another type of frankly pretty popular cash value policy called index universal life. Some of your listeners may own it, may have heard of it, etc. Whole life, though, has been around since the 1860s. It is the most conservative. It is the most stable. It's offered by the strongest companies. So there's just different elements to both. And that's kind of a side note. But what I really want to say to everyone, honestly, is dividend paying whole life insurance from a mutual company. And there's really four big ones that you really shouldn't go outside of if you want to, go with the New York Yankees. Like there's not a lot of New York Yankees out there. It is a better way to save money. And like, that's not a sales concept. That's not really sexy. Obviously, we're just talking about saving money. But if you think about it, if someone has $100,000 in savings, they've been diligently saving, putting some profits in their savings account, even if it's a high yield savings account nowadays, which is higher than it's been in a long time, right? 4 or 5% from the bank. Okay, well, if that's all wow, I'm getting a 5% 12-month CD. Like how awesome. It's principal protected and blah, blah, blah. Let's say that person has $100,000 CD or high yield savings. Okay. And to your point, let's say they need 25K for the earnest deposit on a wholesale deal, or they need 80K on as their 10% down on a rental property or whatever, right? They cannot leverage that savings account into that money. They have to withdraw the money. And 100 becomes 90 or 100 becomes 50. And now $1, it's like a zero sum game, right? There's not a synergy going. They're taking that dollar from one place and they're putting it into the next. Okay. Whole life insurance, it's better. It's just better. If you have $100,000 in cash value, you simply borrow against it. The insurance company is your lender, and the insurance company's main line of business, by the way, is not lending money to its policyholders. So they don't need to charge a high interest rate. It's just like a perk that they give their policyholders. So these whole life companies are doing 4% rates, 5% rates, non-variable. For example, your policy, Benson, has a 5% fixed policy loan rate for life, which means if the Fed funds rate goes to 10% from 5 today, guess what you can do? Still borrow against your policy at 5%. And it's a better way to save money in the sense of you have 100,000 in cash value in your policy. If you need 25K to make that deposit to secure that, property or whatever, you don't have to pull 25K from your policy. You borrow against the 100,000. You still have the 100,000 fully earning interest and crediting and whatever. And now you have this new $25,000 to go multiply in your own deals. And it is a true multiplication of your net worth versus linearly doing a zero sum game. And again, that is a habit of high wealth building people. And so one person may have 100,000 in their cash value and borrow 10,000. Well, client B may have 10 million in their cash value and borrow $1 million. You know what I mean? To buy an apartment building or whatever it is. So that's what I'm talking about, like having the right structures in place to then scale as you scale. That's what we love to help people do.
And can I piggyback on that, Benson? So when it comes to portfolio build out, there's modern portfolio theory, and then there's risk adjusted portfolio theory. So we're of the mindset of the risk adjusted portfolio, and what that basically means, and Ernst & Young came out with a study that has it's 18 pages, and they went through and they tested term life insurance plus investments, investment only, permanent life insurance plus investments, permanent life insurance plus deferred income annuity plus investments plus pension, annuity plus permanent life insurance plus investments. And the portfolio that had the highest rate of return was cash value life insurance plus investments. And so what our advisory philosophy is, if we help a client attain the infinite banking tool, which acts as a down market strategy, which acts as a non-correlated asset inside their portfolio, then we're going to increase the floor. So then when a sell-off happens, like on Friday, and the market goes all over the place and it gets cray-cray, our clients aren't freaking out in retirement. They have this bucket that they can take distributions from and allow the rest of their market correlated assets to recorrect and rebalance and get back to being positive. So at the end of the day, your actual portfolio is going to have an increased alpha, increased rate of return, while you're not taking money from a depressed asset. And that is our philosophy. And that's why this tool that you just asked about is so powerful, because it's literally the Swiss Army knife of financial tools.
Yeah, I like that because it makes me think about like you don't lose money in the stock market until you sell the
Right.
asset.
Right.
So it can go up and down all at once. And this is what people who use those assets for their regular life and a stock goes down, they're like, man, I need to get out and
Exactly.
recoup that money. So they sell and they just lost a bunch of that value. But what you're saying is the stabilization effect of whole life insurance can say that I can take money out of my whole life and leave my stock alone, let that
Exactly.
stabilize and then start to go back up. And I didn't lose anything because I didn't sell it.
Or
Exactly.
guess what? Even more, if you're of the mindset and wherewithal and experience, we have many clients that actually borrowed from their whole life to buy after the
Correct.
market has dropped 20 or 30%. Now you
Correct.
want to talk about leverage and arbitrage. If you're an
Mm.
experienced investor and you know, based off of your knowledge of 50, 80 years stock market history, does it ever stay down for good? No. Do you know what I mean? So how many 20% dips have there been? And retail, which means the beginners have freaked out and sold, but who's bought on the 20 and 30% dips? The smart
Big
money,
dogs.
the smart
Mhm.
money. And even if it's individuals, the smart money. Do you know what I mean? So if you, and I'm talking to you, right? Because now you have one. If you have a whole life policy and you're building cash value, and we're talking about the NASDAQ or Apple, right, going down 25%. Well, what if I told you you could borrow from a stable asset at 5% and buy Apple on the 25% dip? That's powerful. And now we're talking about real intelligent use of leverage.
Correct.
Right. And you're not really like when you say borrow and let's say you borrow at 4%, I don't have a new payment
No,
that I have to
No.
make every month to pay for that like you would if you went and borrowed money from
A bank.
your house or a bank,
correct.
right? Where you got a HELOC and now I've got a new interest payment I have to worry about.
It,
When
it's
you borrow
it's the,
from
the
your own
it's
policy, there's
automatically
no,
factored in.
it's all factored in.
Yeah.
So that would be a concern of mine if I was coming in and thinking, yeah, I can borrow from this, but I don't want more debt, right? People are so
Correct.
scared of debt because that people think that all debt is bad. But if you're out reinvesting that money and you got that arbitrage, right? You borrowed at 4 and now I can go make, you know, 12, 15, 20% on a fix and flip. Like you're still making a lot of money.
For sure. I
Well,
have a client. He works in your space. He's in the real estate space, and what he did was he borrowed at 4.7. He went and became basically the financer for a real estate deal, charged investors 12 to 14%, and he was literally making an 8 to 10% spread on his money. And he also, mind you, purchased a real estate property and then it appreciated and then they flipped it. I mean, it's just that's hard money lending, basically, you know? I
Oh
mean,
yeah.
it's
and
incredible.
I would also say, um, you know, as far as good debt and bad debt and the fear of debt and things like that you were talking about, Benson, you know, certain things that people don't like about borrowing money don't exist in a policy loan, right? Which is a good thing from a life insurance, lending standpoint. So thing number one that doesn't exist in a policy loan, transaction, you could call it, is a personal guarantee. Some people don't like personal guarantees, which is understandable, right? Like you're putting your neck out on the line a little bit. There is no personal guarantee on a life insurance loan. Why? Because it's fully secured by the policy. And so that's why I've done this myself. I go in my Guardian portal, I see how much cash value I have. I literally type in the amount of that I want to borrow up to 95% loan to value, which real estate people appreciate that number because it's very high. Okay. So life insurance policy loans have a 95 to 99% LTV. How
Mhm.
can it possibly be that high? Well, there's two reasons, especially with whole life. Number one, the asset is so stable. So unlike borrowing against your E-Trade account, they will not do a 95% loan to value. E-Trade or Schwab or
No
whatever, they'll
shot.
do a 50% loan to value. because the market is volatile and they don't want to have a margin call. They don't want to lose money. Do you know what I mean? And so life insurance companies know that the underlying asset is so stable, they will do 95 to 99% loan to value. If there's no personal guarantee and there's no credit check. Why? It is a fully secured loan by the policy, which means your investors, your listener, you, me, Steven, we're all in the same boat at this point, right? As policyholders, we go in the portal, we type in how much money we want to borrow today, once a year, whatever it is. The insurance company just double checks if it's 95% or less than the cash value. The last time I borrowed, I got my money direct ACH to my checking account in 72 hours. And then I went on my way because it's fully secured. And I just want to point out, as far as if somebody's afraid of debt or wants clarity as to how the mechanisms work, it is seamless. There's no credit check, there's no personal guarantee because it's 100% secured loan by the policy. And I think that's very important for people to know.
Also, you don't have any liquidity requirements. So
Correct.
when people borrow, the other things that stop people from borrowing money is, well, I need to have a certain amount in the bank so they can make sure that I'm going to make the monthly interest payments, right? So they want to know I have, money in the bank in case, something happens. So that's not there. No credit checks. There's no underwriting process, right? I've been through closings before, and you're talking about 30 to 45 days of underwriters asking for documents. You give them your tax returns and your W-2s and bank statements. And it's like, you feel vulnerable because people are really looking into your private information.
Sure.
You don't do this. I mean, there's some initial underwriting on you individually to get the policy.
Well, to get the policy, right. Yeah.
To get the policy first. But once you have the policy, then you're good to go.
You're locked in.
For the rest of your life, by the way. Yeah.
And keep in mind, like the insurance company, the way we did it with you, Benson, is this is so valuable. I mean, the insurance company is going to forever see you at the age that you locked in your health and your age. So, someone buys a life insurance policy that's funded right and, designed properly. Let's say they're a 43-year-old. When they're 74, they locked in their age and their health at 43. So their insurance cost, it's called the COI, cost of insurance, was tied to a 43-year-old as opposed to a 75-year-old when they're using the policy. I mean, it's a very powerful tool.
We completely forgot about one of the things that is a huge benefit, but in the infinite banking concept, people kind of like they poo-poo it because they don't really care, and that's the death benefit.
Exactly.
Like if I die, my heirs still get money from the insurance company. Like this is what people think about with life insurance. They think about, oh, I don't need life insurance. Like I don't have any kids, or, I'm a young person. There's no chance of me dying. So they're not thinking about the death benefit, but it really is a big benefit that we didn't even discuss yet.
Yeah, I actually think it's probably the most important part, specifically on a well-designed permanent life insurance chassis policy, because the way you design a good plan is you increase the non-commissionable, death benefit, let's call it. And so no one gets paid on that except for the client when they put additional cash in the policy. You increase the corridor is what it's called, while you decrease the COI, the cost of the insurance, which is very interesting. Most people look at one policy and they think this is the one way to do it. You can fund an insurance policy in 20 to 30 different ways. So what we do is we increase the term or the life insurance death benefit, the term insurance benefit on the policy. We decrease the cost of the insurance and we jam cash in to increase the short-term liquidity on the policy. So in the event the client dies, let's say they're actually only paying for $1 million of coverage, but their death benefit's actually $6 million. If the client dies, the heirs get $6 million because that's the plan that we designed for the client. Now, if a client has $6 million of coverage, but they're paying for $1 million, guess what? The client can now shove in a ton of cash in their policy and it won't become a taxable event.
Right. And that's another key thing we didn't, well, there's two things here. Number one, well, let me go back. The other thing I want to mention before we move on from this is how you guys structured this. And
yeah,
I had an epiphany while we were going through this, and you told me to keep an eye out for other companies because I was evaluating other companies at the same time I was talking to you guys.
For sure.
You
And
were what?
yeah, you
No, I'm
weren't
kidding.
you weren't my only date.
So,
I was at the bar talking to others.
okay.
Um, is that a lot of these companies that say that they're doing the infinite banking concept will advise to have a different ratio, right? So where they don't pull out, they don't have the ability to pull out 95%, that they have a more of like closer to 50-50. And they do that, advising them that it's better for the client, but that structure also helps them make more money, more
Yeah.
commission, right?
I think I explained that to you too.
Yeah,
You
yeah.
did. And you guys basically told me we're going to make less money
Mm-hmm.
structuring it this way because that's what you want, right? And you could have, if you had advised me otherwise, I wouldn't have known the difference.
Mm-hmm.
And this is what I think a lot of people need to be really pay attention to, is that the way it's structured can help the financial company make a lot more money, but it may not be in the best interest of the client.
Yeah.
Completely.
I mean, we always, meaning 100% of the time, start with the client. In other words, we start with understanding the person across from us first. Okay. We start with understanding the person's goals, their circumstances, their challenges, their, long-term goals, medium-term goals. That is how we do business. Okay. That's how we do this business. That's how we do anything we do. It's not about a product first anyway, because ultimately it involves a product, right? It's not product first. There's no pitching. Um, there are people, you know what I mean? So we understand the people that we work with first, and then we create a strategy or a policy design, or we bring in a tax expert, and maybe there's no life insurance bought or sold. Okay. And so we understand what is best for the client, and then we bring those people to them. We bring those strategies to them. Um, and then we take it from there. And then it's a conversation. Well, Benson, here is the summary of the first 3 meetings we've had. Here's what we've learned about you. Here's what we know about you. Here's your short-term goals that you shared. Here's your long-term goals that you shared, so on and so forth. Then we present strategies to you, and then you vet them and you poke around, and we answer all the questions you could ever think of. And then once you're clear, okay, then phase 3 is, well, let's execute, right? Let's actually do this. And if the process is done any other way, there may be some short-term increased financial success from the agent in the form of a bigger commission, but it's not the right way to do business. And long term, it's really playing the short game versus the long game. And it's just not sustainable for anyone to do it like that. And even if it was, it's the wrong way to do it. And we don't like doing things the wrong way for anybody.
And I also couldn't agree more, but I also think that the reason, if you look on Google and you type in, is whole life or index universal life a good investment, there's so many negative reviews because of what agents do. Agents will increase their comp and they will decrease the liquidity on the policy for the client. And then the policy won't break even for 15, 16 years. And then people are going to be like, why did I buy this thing? This is a sunk cost. I'd be better in bonds. So, you know, um,
Didn't we set mine up to break even in like 7 years?
no, it's 5.
Yeah.
It's 5.
Yeah.
I mean,
So
that's so short.
yeah, most is
13 to 15.
Yeah, most is 13 to even 17. So
Wow.
it's all about design and structure. And yeah, we take money out of our pocket to make our clients happy. And the good news is we don't have reversals. We don't have clients lapsing their policies. We don't have clients calling us and saying, this is not what I signed up for. We don't experience that because of our diligent process, quite frankly.
Yeah. Oh, I remember in one of our meetings, I was ready to just get going, and then
Remember, I
you
was
guys
like,
Right.
you guys
Right.
did like a whole other presentation on this,
yeah,
and we dug into the numbers, and you guys are like, Benson, we want you to understand
yeah.
how this works, why this works, the numbers. And it was like this full presentation that I would have thought was at the beginning of the sales process, but we had already gotten past me agreeing to work with you guys, and I was ready to go. And you're like, no, there's one more stage here, which I thought was really cool because that built even more trust in what you guys do. And another example, Jason, you referred me to somebody for a
Oh
Roth
yeah. Yeah.
IRA, right? So again, you're thinking about all of the stuff organically, right? Not just this one vehicle. You're like, man, you should get one of these too,
Right.
right? And so there's another vehicle there. And then again, let's not forget another one of the biggest selling points for me in the whole life, which is tax-free gains in the investments and the money that I borrow and invest in a fix and flip, bring that money back to the policy. If I had done that same flip with money out of my checking account, I'm going to have capital gains. I'm going to have additional taxes, and that's going to cut into my profits. But if I use the money from my policy to do it, all of those profits come back to the policy tax-free.
Right. I mean, listen, the whole, and this is what I talk about every day with people, when this topic comes up of leverage. Um, the modern economic world is based off of leverage. And for people that don't know that, they should, okay? Because it's not like a scare tactic, or it's not some conspiracy theory, in other words, is the better way to put it. It's just a modern economic reality. The whole system's based off of debt. In other words, money issuance. And what the government's in $29 trillion in national debt. Well, that's a different podcast. But like, and even the whole rich dad poor dad awakening that a lot of people had, like, wow, there is such thing as good debt. I can use debt to make more money intelligently. Do you know what I mean? You're not borrowing at 10 to buy a new TV, right? You're borrowing at 10 to make 20. You're borrowing at 5 to make 10. Okay. And I don't know, that's just like, that's a key topic that I try to hammer home with people when this topic of borrowing against your policy comes up. It's like, you're not going off the beaten path that other wealthy people don't do these things. This is how wealth is created, especially in the modern world. What do hedge funds do? Hedge funds raise $100 million. They go out and borrow $100 million, and then they trade with 200 million, and then that $100 million of investor capital gets the returns of $200 million in the market.
Mm-hmm.
And on an individual level, that's what we teach people to do.
Wow. Stephen, earlier you mentioned another factor here that I didn't think about, but I can actually go and borrow not from the mutual company, but from another company, a bank,
Correct.
who will use my policy as consideration.
Yeah.
Correct.
Right. For the
We call
loan.
that the I block, the insurance back line of credit. And it's a very powerful tool. And I love it when a business owns the policy and it's not personally owned. Because what we'll do is we will collateralize the policy with the mid-tier bank. You're not going to do this at like BofA or Wells Fargo. It's going to be a mid-tier bank that we have the relationships at, and we'll introduce you to these people. But what they'll do is they'll give you a line of credit, and that line of credit will increase in conjunction to your cash value increases. So you don't have to get underwritten every year. So when your cash value goes up in policy year anniversary 1, guess what? Your line of credit does now too, and down the line. And so what you can do is you can borrow from them at, Fed funds. It's very cheap interest because, like Jason said, it's a stable asset. So the banks are willing to lend at the cheapest rates with you because you have cash value life insurance. And they know that if you default, they can come in and clean up, take your policy right away from you. So they give you very favorable rates, and then you can deduct the interest that you're borrowing if your business owns the policy. So now you're truly using other people's money, and your payback period with the bank is like 6 years. So if you're borrowing at cheap interest from a bank, you deducted those monies, your lend rate is going to be cheaper than even doing it from your policy directly, because you're doing it from the bank and you're deducting the premium, the interest rates. And now you could do the same concept. You deploy that elsewhere. You're borrowing at a really cheap rate. You're getting a higher spread. I mean, I do this, to be honest.
Wow. Is that rate from the bank variable? Does it change?
It depends how we set it up. It can be variable. It can be fixed. You choose off the onset.
Got it.
Yeah, I mean, so to that point, just a little anecdote. So I have a client who's also a longtime friend. We played football together at college, so we go way back. And he knows that, I mean, he just knows implicitly that I am guiding him in the right direction with the most integrity. And it feels it's incredible because somebody like him, kind of, especially, you could say, literally could work with anybody on the face of the earth, you know? And so one interesting question he asked during the process, you know, similar that we went through with you, um, we were presenting to him, hey, you know, by the way, like, his whole world is private equity and interest rates and arbitrage and private credit. And, you know, he's a partner at a publicly traded private equity company. So he's intimately familiar with all these terms. And so we were saying, hey, you know, this cash value that you're building up, you could Guardian, he's using the same company as you actually. Guardian will lend money to you against your cash value at 5% fixed for the rest of your life. And right now, today, with prime interest rate being whatever it is, 8.75, 8.5,
Yeah.
that's appealing. And so even kind of a side note is, right now, you don't necessarily want to use an insurance-backed line of credit from a mid-tier bank because they're going to charge you higher than Guardian, like by a long shot. But what he was saying was, well, okay, cool, I could borrow at 5%. Great, that makes sense today. But what if the Fed funds rate goes back down to zero?
Yeah.
What if there's a mega recession and I don't want to borrow at 5 because I could borrow at 3 somewhere else? What do I do then? And we say, oh, well, here's an elegant solution. You don't have to use the insurance company as your lender. You take your policy cash value to a bank who will charge you market rates at that time, which could be 1%, could be 2, could be 3. So the reality is, in short, the policyholder has the choice of where to go for the lowest rate. Sometimes in the market cycle, the insurance company will have the lowest rate. Sometimes in another part of the market cycle, their rate will be higher than you could get at a private bank. So you go to a bank.
Exactly.
Wow.
And then Benson, you know, just to piggyback off that, there's multiple different types of insurances. We're talking about the infinite banking today, obviously, but Jason and I also help people with LIRPs. So that's the life insurance retirement plan, which is completely different than the IBC, but the LIRP is going to be more lesser guarantees. So like a 0% floor, but some policies have uncapped earnings, which is remarkable. So you could get, you know, 33% rate of return. This is no joke. I have this policy exactly inside of a life insurance policy. So your standard deviation is about, you know, a 4, let's call it, and your rate of return is 33%. So we're talking about a safe asset that is still not correlated because you're not going to drop below 0%, but you can get market-like returns inside your policy. So
Wow.
those exist too, and we help people with those all the time. But those are longer term plays. That's not a short term vehicle. That's a long term vehicle.
So now we're getting into like the overall like financial planning stuff, right? Because we focus most of this podcast on whole life insurance, and that's what I had the experience with. But you guys do all kinds of different financial planning strategies. What are just some of the ones at a high level that you help high net worth people accomplish?
Jason, let's piggyback off each other. I'll start. So
I'll start. LIRPs.
Yeah, okay. So LIRPs, and then what we do is we finance life insurance policies. We basically help clients get a lot of death benefit, and we have banks pay their premiums, and then they're just required to pay the interest that they're borrowing, and that could be deductible too. We do on the business planning side, supplemental executive retirement plans. We can do executive bonus plans. We can do non-qualified deferred comp strategies. We can do key man buy sell strategies. You can get very convoluted with them. And then on the flip side, we could do group 401k, group health, group DI, group life. Section 125 plans, I'll let Jason talk about those a little more. And then on the personal side, we have an investment arm. So we manage money. So building portfolios for clients in a holistic manner, obviously risk management, personal insurance, disability insurance for the business owner, disability buyout. We do succession planning, exit planning. Jason, what am I missing? Oh, estate planning. Yeah.
Yeah. I mean, all that and more. I mean, in our experience, Benson, and I'm sure you could vouch for this. Anytime you tell someone that there's potential to minimize their taxes, they will at least listen. Do you know what I mean? And so, especially the more, and the reality is, even though it's still all relative, like 30% of one is that 30% is still 30% of a million. It's just on bigger numbers. In other words, it's still 30%. The reality is, even though it's still 30% on this level, when people, pay 30 or 40 or 50% of $1 million income or a $5 million income, they really feel it and they really don't like it. Okay. And so we deal with a lot of people like that. Whether it's 300K income or 3 million or 15 million, or obviously pick a number, pick a big number. Income tax planning and income tax mitigation. And we tell people, even I'll say this right now, we are not CPAs. Like, I'm not a certified public accountant. And we let our clients know that it's no secret. Just like I'm not an estate planning attorney. Okay. But we have access to, not only access, close professional relationships with some of the best, tax credit specialists, tax mitigation strategists who are CPAs in the United States of America, that will take my call and Steven's call, 24/7, so to speak, and say, hey, we have a client, high net worth, high income entrepreneur that is looking for legal, creative tax reduction strategies on their personal income. What to speak of enterprise level, income, what to speak of multi-generational wealth transfer tax saving strategies, which is really estate planning. And so that is the other, or another value that we bring to our clients, just like I unconditionally shared that IRA strategy with you, Benson. Like, that is a really good example of what we do. Like, it's not just life insurance. It's not just whatever. It's we bring people to clients that can help them. And a huge part of what we're doing, honestly, more and more every day, because of the clients that we're bringing on, is we're introducing them to some of the best tax mitigation CPAs in the country, some of the best estate planning attorneys in the country, and we're building a team around everybody we work with.
And you know what's cool, Benson? Last week I was in New York and I got invited. I was a principal of, there are 15 other principals at firms throughout the country. And we got invited to go to the New York Stock Exchange to meet with the traders that manage the indexes for the Index Universal Life Chassis, which is the LIRP that I was talking about. And I was rubbing elbows. I was by far the youngest one by a long shot. And I was rubbing elbows with men that have had firms for decades, that have huge institutions at this point. And I was representing Elevate. And the strategies that these people do for their ultra high net worth clients, Jason just mentioned, we are doing the exact same thing, but we're way younger. So the coolest part is the growth trajectory that we're on is substantially, they said this, they weren't in my shoes when they were my age. So the growth that our firm has taken and where we're headed is astronomical. We're doing really well. And it's simply because we are putting together that team around us that we can introduce our clients to for estate planning, for entity structure, for tax mitigation, you name it. We're building it and we're cultivating it to simply help our clients.
Absolutely amazing. These kinds of conversations get me so excited. And there's so much we didn't even talk about today.
Yeah.
We just scratched the surface, but I felt like we did a pretty deep dive on whole life insurance, which is how this conversation started, and where a lot of people that I'm talking to in the circles that I am with real estate investors. So this is definitely something that people should consider. And if people are interested in learning more about it and talking with you guys, how can they find you?
Numerous places.
Yeah, our website, www.elevatefinsvcs.com. They go to we have an advisory advisor section. They click it. There's a drop down and it'll have like what advisor they want to work with. So that's one way. They can reach out on our LinkedIn's. My name's Steven Peterson. That's Jason Rotman. make a connection that way. They can email us. Emails are very similar. Mine's sjp at efinsvcs.com. Jason's jason at efinsvcs.com. And then obviously our numbers, we can give you our numbers.
And I'll add one more. We do a webinar once every 2 weeks.
Oh yeah.
And that is kind of blowing up a little bit. Like it's really growing every 2 weeks. And I say that humbly, like very excitedly. It's like, it's really kind of starting to gain traction. I lead the webinar and it's 60 minutes or so. I literally stay for 20 minutes sometimes just to answer people's questions. But if anybody wants a deep dive into the other topics that like we didn't discuss yet, or that we touched upon, premium financing, life insurance as a retirement strategy for tax-free income, we definitely go over, using policy loans for arbitrage and even 2 other strategies. That's on my LinkedIn profile. So Jason Rotman, go to check out my LinkedIn profile. And then the little button that says visit website, I just linked that to the webinar page. And if anybody wants education, I mean, it's the webinar is getting fantastic reviews from very, very experienced financial people. And it's been really helpful for people to learn about some of the things that Stephen and I do.
Awesome. Well, you guys, thank you so much for taking the time. If anybody reaches out to them, make sure you let them know you learned about it on the REI Hacker podcast.
Absolutely.
I mean, this is where we really go to bring in the highest value guests who can really teach you something new that you can use in your business. So Jason, Stephen, thanks for taking the time. And all the listeners out there, appreciate you checking out this edition of the REI Hacker podcast. Keep an eye out for more really cool guests like the men from Elevate here. And we're always going to bring it with, education and business strategies and inspiration and success stories that you can use in your business. So thanks again for listening, and we'll see you next time.
Thanks so much, Benson.
That's a wrap on today's Real Estate Revelations. Thank you for tuning into the REI Hacker Podcast. Remember, every property has a story, and every deal is a lesson. Until next time, keep hacking the real estate world.